All right, so good morning, everybody. We are here to talk about FHA loans today. Now, we can't sit down in 1 hour, 90 minutes, 2 hours, 4 hours, and cover everything we need to do. So the intent today is to show you the primary ways that FHA can do deals that right now you're not doing, because there's a lot of advantages with FHA loans. And they bring to the market something that's very, very unique. They work almost everywhere. And the bottom line is, if you become very, very good at FHA loans, you will do loans that other people can't do. I don't need to tell you the benefits of that. So without any further ado, let's just get started. I have sent to most of you in the past a link to where you can actually get to the FHA website, and you can get to their underwriting criteria, which is known as the 4000.1. The 4000.1 was just updated online. I mean, we're talking November of 2021. FHA is in the process of taking a lot of their previous changes and updating them to where everything is now available online. So if any of you have that bookmarked, make sure when you go into it that you're actually going into, and it's pretty well marked, but just make sure that you are seeing November of 21 as your update. So how do we close more loans? How do we help more buyers? At the end of the day, how do we make more money? Well, when you click the button, the PowerPoint's supposed to move. So that's exciting. Okay, wait one, technical difficulty, and we're on the very first slide. So that's awesome. Here we go. All right. Somebody's got some background noise on. If you could please turn that off, I would appreciate it. Thank you so much. Okay, so what are the advantages of the FHA loan? I mean, I keep telling you they're here, but what are they? Well, the first one is that there's less cash needed to close. You, of course, can put whatever money you want down, but 9 out of 10, 19 out of 20 deals that you do are going to have the minimum 3.5% down payment. And while it does vary by state, and in the wonderful state of California, it varies between Northern and Southern California, as a general statement, the overall closing costs to do an FHA loan are about 1% of the sales price. It's a little more than that in Southern California. In Southern California, we have higher escrow fees than in Northern California, maybe closer to 1.25% in Southern California. But again, you know your territory. You could be in Kansas City, you could be in Austin, you could be in Des Moines. You'll know your area. Your impound account typically costs about 1%. So your total cash needed to do an FHA deal is typically about 5.5%. Again, little bit of regional difference in closing costs, and a borrower could always choose to pay points on top of this to buy their rate down. None of those things happen very often. 5.5% is what you typically need. These loans are easier to qualify for. They are significantly easier. They have much lower credit scores that are required. They overall have more lenient underwriting criteria across the board, from job stability to ratios to credit to assets. And what used to be a significant advantage of these loans is that you could use both automated underwriting systems and a manual underwrite. Now, COVID has changed a lot of this. And right now I need to throw out here the disclaimer. Many of you understand what happened when COVID first hit. And we went through about a 60-day period of time where almost every FHA loan in the country was put on hold. The investors wouldn't buy them. Wall Street wouldn't budge. Nobody knew what was going to happen with the pandemic. Are we going to lose 2 million people like the original prognostication that came out of Great Britain told us we were? Nobody knew what was going to happen. So we went through a freeze in the credit markets that was horrible because FHA does not give loans. Lenders give loans. FHA insures the loan. So FHA can say they'll do whatever they want, but they're not actually giving the money. See, at the end of the day, Fannie and Freddie buy the loans. They are the investors. So if they say, I will do this deal, well, they'll do the deal. FHA doesn't have the same authority or the same procedure. They insure the loan. The loan still has to get sold to an investor. The loan still has to get sold to a servicer. And if those people feel that their loans are in jeopardy, then they're not going to buy them. So what we have seen since COVID is we have seen a huge change in credit score requirements, and we have seen a huge decline in manual underwriting. There are many lenders out there, including Jet Direct Mortgage, that do not do manual underwrite loans of FHA loans right now in today's market. Do I think that's going to change? Oh, of course it's going to change. Frankly, I'm a little surprised it hasn't changed by now, because our credit requirements have gone almost back to normal. More about that in a couple of minutes. Buyers can buy more house with an FHA loan. I mean, everything else being equal, just the difference in how we look at the DTI will add $25,000, $30,000, $40,000, $50,000 onto the purchase price. We have lower interest rates on FHA loans, and depending upon your credit score, they can be significantly lower. I mean, you take somebody with a 675 score, that's not bad credit. I mean, it's not great, but I mean, it's average. 675 score is just fine. With an FHA in today's world, you're looking at a 2 3/4, 2 7/8. In the Fannie Freddie world, you're looking at 3.5 to 4. That's a pretty significant difference. We also can have higher debt ratios, as we talked about. And one of the biggest differences on the FHA loans is that they put a lot of priority on comp factors. If you've got a comp factor on an FHA loan, it can really, really, really make a difference. And bottom line is in the math. So here's the math. And these statistics come from FHA directly. So far in year-to-date 2021, 46% of all first-time homebuyers used the FHA financing. That number is actually low. That number is lower than it has been in years past. But if we can use round numbers, half of the first-time homebuyers in this country still use FHA. If you're not a master of FHA financing, you're missing out on a significant portion of the market. All right, so we talked about credit being more lenient. Let's get into a little bit of detail here. These are the FHA regulations, the guidelines. They will allow that 3.5% down payment down to a 580 score. They will still insure loans below 580, but you have to have 10% down. Now, like we talked about a minute ago, COVID has brought significant overlays to this. Right now, in today's world, November of 2021, we have now got 3, or I believe actually now 4 of our investors will go back to 600, but we don't have any investors that will go below 600 at this time. And that answer is going to change from lender to lender across the country. The big banks are still stuck at 620. Wells Fargo is still at 640, and different mortgage bankers are wherever they are. So while FHA still says they will go down to 580, finding that loan right now in today's COVID world is difficult. And all I can tell you is check in. It's all you can do is check. Because of course, this, like all overlays, are subject to change. The overall tone of the market has gotten more lenient, but we still have not gotten below 600. Now, FHA treats significant credit events significantly different. You are eligible for a loan 24 months after a Chapter 7. And to be brutally frank, you don't have to do much. I mean, when I say eligible, it doesn't mean that it's automatic. But hey, if you haven't gotten any late payments on anything in the last 24 months, that's from date of discharge, of course, we all know that. And even if you've just gone out and gotten one new secured credit card, just those two things, you're going to get a new FHA loan. You're eligible for a loan immediately after a Chapter 13 has been discharged. Or if you're still in your Chapter 13, typically you're either on a 3-year or a 5-year payment plan. If you're 1 year into that payment plan and that payment into your DTI allows you to qualify and the trustee says it's okay to buy a house, you can buy a house and you're still in your payment plan. That is crazy. Now, a lot of people say, yeah, but will the trustees actually do that? Yes, I've closed several of these loans personally. I mean, you're paying out $2,000 a month in rent and your payment's $2,000 and you're paying off your payment plan as agreed and you've got decent reestablished credit. Why wouldn't a trustee want you to get more reestablished? It's only 36 months after a foreclosure, a deed in lieu, or a short sale. 36 months. Fannie Mae is 7 years. Short sale is 4 years. You can get a BK through after 4 years, Fannie and Freddie. It's 2 years on FHA. 2 years instead of 4 years? 36 months on an actual foreclosure instead of a full 7 years? That is crazy difference. That alone will allow you to close loans that other people can't close. I would be pounding years and years and years in the field, pounding the drum, that I can get you market interest rates with no points 2 years after a BK. And that's all I had to put as the headline of the flyer. The phone would ring. Every time I passed that flyer out, the phone would ring. Every time that email went out, the phone would ring. Market rates, 0 discount points, 24 months after BK. Call me. Marketing doesn't get any simpler than that. Okay. FHA offers a lot more flexibility on that cash needed to close. Now, on the first screen, we talked about how little needed to close. Well, now let's kind of look at how that breaks down a little bit. Borrowers need to come up with their own down payment, but 100% of those funds can come from a variety of sources. So you will see a lot of stuff in the FHA guide that says, oh, no, a borrower's got to have their own payment. A seller can't pay it, a lender can't pay it, a realtor can't pay it. Those are all true. But from their own money doesn't mean checking and savings. Now, checking, savings, stocks, bonds, mutual funds, all that stuff, yes. Can you liquidate from a 401k and IRA? Absolutely. But the number one way that FHA gets a little more creative and a little more flexible is by allowing gifts. A huge difference between an FHA gift and a conventional gift. FHA includes in their donors a close personal friend. That's the actual language in the guide. Now, for years and years and years and years and years, we had people who lived together. I would affectionately refer to them as a shack-up job, pardon my sense of humor. But people would live together, but for whatever reason, one of them couldn't go on the loan. Usually it was credit. Oftentimes somebody got involved in a bloody divorce or something like that, and they just, their credit was terrible. But they had the money for the down, or they had half the money for the down. Fannie and Freddie don't acknowledge that. That person cannot be a gift donor. FHA does. You have to document the close personal friend relationship. Doesn't get any closer than, okay, I was about to be, yes, I'm not going to go down that road. Close personal friend, show the relationship. How do you do that? Well, in that case, it's a letter. If it's an old college buddy, they may want to see pictures of them on your Facebook account. They may want to see you standing in their wedding as their best man. I mean, Depending upon the circumstances and the underwriter, you may actually have to show something more than just a letter that explains the relationship. You can sell an asset. You can refi an asset. You can use a down payment assistance program, and different states around the country have fabulous programs. Now, we're in California. We've basically got two programs. Cal HFA is by far the biggest and most popular. It's a state of California program. You've all taken those separate classes. You know how they work. 100% of the cash to close can come from that program. The state of Florida has 15, the last time I was there, they had 15 or 16 different down payment assistance and bond programs. The state of Texas has about 6 or 7. Different states have different options. They're all allowed. FHA does not require a single dime actually come out of a borrower's checking or savings account. They don't have to have any money into the deal. Forgive me. They have to have money into the deal, but it does not have to come from accumulated savings. The down payment can come from any of those sources. But the closing costs and impounds can not only come from those sources, but from additional sources. A seller can pay. Yeah. I know. Today's market, Lyman, sellers won't pay fees. Not true. Not true. It's depending upon the transaction, the region, the state, and the market. Now, I will freely admit to most of you, especially here in California right now, from the very north to the very south, it's a very tight market, and getting a seller to pay fees is difficult. It is. And they're certainly not going to pay up to 3 or 4%. But if they pay 2, 3, 4,000, is that enough? I know Chris just had a transaction where they were going to pay $6,000. Ended up flipping that over into some property repairs instead. But don't tell me that no one pays closing costs. They do. You do have interested party contributions, or IPCs, on an FHA loan of 6%. The realtor can pay from their commissions. Now, there is some disclosure issues here. The realtor can't just run in at the closing table and say, oh, did I forget to tell you I'm giving them $4,000? Yeah, I'm giving them $4,000. No, it doesn't work that way. It's got to be in the sales contract, and we have to have been disclosing it in loan estimates and closing disclosures. So LEs and CDs have got to reflect this, and it's got to be in writing, but perfectly allowable. Understand this list here now is for closing costs and impounds, not down payment. Okay, there's the difference. Who else can pay? We can pay. We can use rebate pricing. And I've had this conversation with everyone who's on this call today. Everybody who's in this training, we've had this conversation. Sometimes kicking a rate 1/4 of a point and picking up $3,000, $4,000, $5,000 in rebate pricing to go toward fees makes the deal when nobody else could make the deal. And your borrower pays a $50, $55 higher payment, and they now own a house. It is very, very common for an FHA buyer to use any or all of the above. Questions about any type of down payment assistance, stocks, bonds, 401k loans, liquidations, savings bonds. FHA couldn't get more flexible. About the only thing I really see them say no to is a susu. And if you don't know what a susu is, then you're not from Jamaica, man. You're not from the islands. Okay, that was terrible. I know. Sorry. Savings clubs, if you're familiar, that's what a susu is. If you're familiar with savings clubs, no one allows that kind of money, including FHA. Questions about this at all? Excellent. Then I'll keep going. Now, if everything to do with an FHA loan was all about puppy dogs and rainbows, then every loan in the country would be an FHA loan. But they're not. FHA loan has their advantages and their disadvantages. And many of you have heard me say, and if you haven't heard me say this before, allow me to interject now. With everything else being equal, the borrower could go FHA or conventional, and everything else is equal. You go conventional every time. And the reason is because of the cost of the mortgage insurance. FHA mortgage insurance is high. But is it really? I mean, we're going to compare that. But you have FHA mortgage insurance cost. FHA collects both an upfront premium and a monthly premium. The biggest difference is not only the upfront premium in addition, but the fact that if you put 20% down on an FHA, it means nothing. You're still going to pay mortgage insurance. You're still going to pay what is currently going to be the rates, both upfront and monthly. So a lot of people will come in and they'll say, wait a minute, I'm putting 25% down. Why would I pay mortgage insurance? Well, if you could go conventional, you'd go conventional. Well, but I want to go FHA. Yeah, well, there's a reason for that. Oh, you're 2.5 years out of a bankruptcy. I understand. Now I know why you want. Sorry, folks. It's the price you pay. If you have to buy a house with FHA, then you have to pay the mortgage insurance. That's just the way it is. And that's just the way you need to explain it to the customer. And the customer, once you kind of reason with them, they'll get it. Sometimes it's the realtor that you have to really batten down on and say, look, would you please go sit in the corner and dummy up? Because if you keep talking, you're going to talk this borrower out of buying, and then neither of us get paid. I don't want to go into a whole lot of detail because it's really not important. But FHA self-insures. A lot of people say, well, why do they charge so much? Well, because they self-insure. Fannie and Freddie, they outsource their mortgage insurance. That's where the MGICs of the world and the national MIs of the world and all of these folks, those are private mortgage insurance companies. That's why they're called private mortgage insurance. Those are third parties that actually provide the insurance. FHA self-insures. No one else does that. They collect that upfront premium and they collect those monthly premiums, and it goes into a side account that gets monitored by Congress every year. And there's financial reports that get given to Congress every year by FHA. That cost that they charge goes up and down. We have been charging a significant amount of money ever since the recession, because prior to the recession, there was $24 billion in that account, and it got down to $2 billion with all the claims that got paid. And there's a federal mandate that they have more money in there. So they raised the cost of mortgage insurance, and they've been building that fund back up for the last 8 or 9 years. And when they get it built back up to where they want it, they'll drop the cost. But right now, here's the cost of mortgage insurance. Don't look at this and get all confused. 95% of all loans you do in this country will come under one category. That's the top box, mortgage term more than 15 years, because virtually every FHA loan you do is a 30-year loan. It's going to be less than or equal to 625.5, and it's going to be greater than a 95% LTV. Okay? 19 out of 20 loans. Okay, that's probably a little much. 9 out of 10 FHA loans that you do in your entire career will be a 3.5% down loan under 625,500, unless you reside in a high-cost area, like Philip's over in Ventura County, and he does a lot of LA County, Ventura County stuff. So, okay, that's where he lives. Everybody he knows is there. He's going to do some that are above 625.5.
I'm LA County.
Oh, I thought you actually lived in Ventura.
Nope.
Nope. All right. So you're LA County. And there's going to be other people who watch this training video, and they're going to be in New York City, or they're going to be in Aspen, Colorado. Okay. Some of you might do loans greater than 625.5. And if you do, the mortgage insurance cost is a little bit higher. But what does it cost? Okay. It's 85 basis points. I mean, again, 9 out of 10 loans you do is going to be 85 basis points because they're putting 3.5% down. If it is, in fact, a high balance loan with 3.5% down, it's 105 basis points. What is the upfront cost? Again, hold on here. I'm reading it. Basis points, duration. It's not in the chart. Oh, that's embarrassing, Lyman. Well, the upfront, where does it say that? Your upfront cost right now is 1.5%. It doesn't say that anywhere in the chart. It only talks about monthly. Huh, okay, I didn't know that. All right, your upfront cost is 1.5%. I should probably add that in there somewhere. I actually copied that chart right out of the FHA manual. Huh, does anybody see it on there? Did I know? That's only the monthly. Okay. So you're never going to do an FHA loan for 15 years. They're all going to be 30 years. So it's either going to be a high balance, which is 105 basis points a month, or it's going to be a regular loan, which is 85. Yes, it says on there, hey, if I put 10% down, is it a little bit less? Yes, I'm just telling you, you will hardly ever do an FHA loan with 10% or more down. So it's 1.5% upfront and 85 basis points included in your monthly payment. Now, think about a conventional loan. If you've got a score over 720, that monthly basis points is lower. What is it at 700? And what is it at 680? Because at 680, it's significantly higher. It's like a point. And when you get down to 660, it's like a 1.5 points. And when you get down to 640, 620, it's like 2 points a month for a conventional loan. So let's all keep this in perspective. Is FHA mortgage insurance expensive? Well, on a monthly basis, if your score is below 700, no, it's actually less. But you're still dealing with the 1.5 up front. Now, that 1.5 up front is added to the loan amount. Can you pay it in cash? Yes. I just did an FHA loan, closed 60 days ago. I raised the rate 1/4 point, and I got enough money to buy out my upfront FHA. Bought it out. Why? Because I'm going to sell my house in 2 years. So why would I rob myself of $6,000, $7,000 of equity when a 1/4 point in rate created enough rebate to pay it in cash? Oh, but Lyman, your payment's $60 a month more. You're right. 6 times 12 is what? $720. So if I keep the house 2 years, it's $1,440 I paid in extra monthly payment to save $7,000 up front. So you can buy it out, pay it in cash. Almost nobody does. They add it onto their loan, spread it out over 30 years at a ridiculously low interest rate, and nobody cares. Questions about mortgage insurance? Okay. Listen, folks, FHA brings a lot more to the table than just lower cash, lower credit score requirements, and higher DTI. Although, obviously, that's important. But the devil's in the details. So what are some of these things? Judgments, including IRS tax liens. How many times have you got a borrower and they're in a payment plan with IRS? They've got a tax lien and Fannie Freddie says, no, you got to pay it off in full. Well, it's $10,000. Sorry, got to pay it. FHA does not require you to pay it. FHA says you need to have a written agreement and you need to make 3 payments. Booyah. Bankruptcy. We talked about 2 years, short sale, deed in lieu, and foreclosures are 3 years prior to the new case number being ordered, which is why I listed it here as the devil is in the details. So it's not closing date. They changed that. It used to be closing date. It was closing date for the first 20 years of my career. But a few years ago, they changed it. You cannot order the case number. Does that mean they can't write a sales contract? No, they can write a contract, but we can't get a case number and order the appraisal until either that 24 or 36 months has elapsed. So you need to educate your buyers and the realtor to that fact. If our 24 months on the bankruptcy is January 1, and we've pulled their credit, they've reestablished, you've had no new lates, they got a 660, 680 score, and everything is good to go. We just need to set the timing. Then here's the timing I would tell people. You better not write a contract before December 1. And if you write a contract for December 1, you better write it for about a 45 to 50 day close. And if the realtors are saying, hey, in today's market, I can't get a contract for more than 30, 45 days, well, then you better not write it until about Christmas time. Because again, in today's market, appraisers are taking a long time. You better allow 2 to 3 weeks for that appraisal. So if your 24-month bullet or 36-month bullet is January 1, I think if you try to set a close date before January 15, you're setting yourself up to fail. You should probably try to get your contract for January 30th. But if you could get to the 20th or 25th, you're probably fine. So again, they don't have to. So what about new construction? That means you could go out, and if they just started the house in September or October, it's not going to be done till January. So you're fine to write that contract on new construction, even though they're on their 21st or 22nd month, or their 33rd or 34th month. You just cannot order the case number. Ooh, here's a big one. Alimony. We can add it into the DTI, and if that's fine, it's fine. But if your DTI is too high, you can subtract it from income instead. In other words, if you make $5,000 a month and you're paying out $500 in alimony, but you got a couple of cars and some credit cards and a tax lien, it might kill your DTI. But if you take your $5,000 a month, reduce it by the alimony, now you're running your DTI numbers on $4,500 a month, but it's not including that $500, you may be fine. You could do that either way with alimony, with an FHA loan. Not true with child support, so don't call me, but you can do that with alimony. And depending upon the debt structure, it makes a deal. Because by reducing income instead of adding to the DTI, you can get a lot more done in certain circumstances. Student loans. They just changed their student loan policy a few months ago. FHA used to have the hardest of all the investors. Now they no longer do that. They will now use the payment on the credit report, including any income-based payment plans, including that. They never allowed that until just a few months ago. If the credit report says 0, we can't just accept 0. We've got to either use a half a point, and again, until a few months ago, it was a whole point. Now it's down to a half, which is the same as Fannie and Freddie. Or if we can actually document that they're on an income-based payment plan, and that payment plan is calling for a 0 payment, then you can use the 0 payment. Just do not get in the trap of you see 0 payment because it's deferred. That doesn't matter. Does not matter if it's deferred. You cannot use 0 unless 0 is the income-based payment plan. And if you don't have that, then you use a half a point. This is awesome. You can't make this happen on Fannie or Freddie. If you've got a closed-in debt, meaning a car payment, signature loan, something like that, maybe it's child support. FHA says, hey, if you got less than 10 months, we don't have to include it. Just like conventional says 6 months. And we all know that underwriters include it almost every time. And we jump up and down as originators, and it doesn't matter. because the guides all say unless it has an impact on credit and payment abilities, and underwriters always tell you that it does. Okay. We can argue that point on another, I need a whole nother cup of coffee for that one. But FHA has now put it in writing. If the debt will be paid off within 10 months from the date of closing, not the date we approve, not the date we originate, and the cumulative payment of those debts are less than or equal to 5% of the borrower's gross monthly income. What does that mean? Okay, if a guy makes $5,000 a month, 5% of that is $250. So if you've got a car payment with 9 payments left, and that scheduled payment is $300, you have to include it. Well, I'm sorry, an underwriter still has the ability to not include it, but they're going to include it. But if the payment's $250, no, guide says, boom, you're good to go. So we actually have written directive from FHA on specific instances where we don't have to count the debt. Just do the math. That's an awesome one. That will make deals when other people decline loans. Collection accounts. If your cumulative number of open collections is greater than $2,000, you got to pay them off. You got to be on a payment plan, or we can just take 5% and throw it into their DTI. Medical not included. Medical is excluded. If the whole collection, if all your collections are medical, they don't count at all. No payments at all, ever. But if the non-medical, whether it's 1 or 5, if it's greater than $2,000, we don't have to do anything with them except just throw a 5% payment into their DTI. Well, what if that blows the deal? Well, then we got to deal with it. Get them on a payment plan, get an acknowledgement from the creditor, and they only have to make 1 payment. Non-occupied co-borrowers are allowed on the 3.5% down deal on a single family. If they are buying units, they got to be putting 25% down to use a non-owner occupied co-borrower. Just to be clear, you can buy units owner occupied for 3.5% down. You just can't have the non-owner co-borrower. Check that out. Section 8 and all public assistance can be used with no proof of the 3-year continuance. This is huge, huge, especially for you, Philip, because we all know LA County gives away more money than any county in any state in the country. Go to the LA County website. They brag about it. They put right on there on the first page, they put LA County proud to assist 2 out of 3 families. 2 out of 3 families in Los Angeles County get some type of assistance.
I have a question.
Yeah.
So what about that $300 child tax credit that a lot of families are getting now? Would that not count because it's technically a they're giving you an upfront payment for your tax credit for the following year? Or would that 300 be something we could use? Because I have a borrower right now. She gets that. I didn't count it in.
No, can't use it.
Okay.
Because technically that's not public assistance. Assistance is an ongoing. And oh, by the way, and here's, I closed a deal 4 or 5 months ago. It was a $500,000 deal in Vacaville. Go figure that out. And my paycheck was $6,500 because I knew how to use foster care income to qualify. They used to have, FHA did a change in their guidelines a couple of years ago. They used to have all these different kinds of public assistances broken out, and they've done away with all of that. And they now just say, they itemize Section 8 and then only say public assistance. They no longer define public assistance. So I went in and argued. The realtor called me, hey, I got a loan decline because they won't use foster care income. I always thought you could. I said you can. And I put together a deal that another lender couldn't do. Got paid over $6,500 to do it because I simply knew that foster care now is lumped under public assistance. And to be brutally honest, I kind of had to point that out and negotiate a little bit with the underwriter and get the underwriting manager involved. And we actually even called FHA. I called FHA and talked to the Hawk, and the Hawk said, yeah, that was part of the rule changes. We're now including all of that stuff. And, the underwriter said, I didn't know that. So all public assistance has now been lumped together. That will make deals where deals can't be made. I mean, we've got people out there knocking down $2,000, $3,000, $4,000, $5,000 a month. Chris, you had a borrower with some daycare money coming in from the county. That's all acceptable now on an FHA loan. Auto allowances can be used if they've been getting it for 24 full months. And unlike commissions or bonuses or overtime, don't come at us trying to justify 18 or 20 or 22 months. Nope. The guide is very specific now. You must have a 24-month history of receipt, but then you can use 100 cents on the dollar as income. You can use expected income under certain circumstances. Non-taxable is grossed up 15%. Vince, I'm not sure if you know that you took yourself off of your background because we all see you conducting the orchestra. What in the hell are you doing?
Oh, I'm talking quite.
You're sitting there preaching to the choir about all the loans you're going to do with FHA. That's what you're doing. All right. Cash on hand. How many times have we all been told you cannot use cash on hand?
I was in a meeting. And he caught me.
Yep, I caught you, Vince, and now we all hear you talking about it. Got you again. You need to mute us. Thank you, sir. Cash on hand is allowed with an FHA loan. Cash on hand is allowed. Now, it has to make sense. Hey, folks, please make sure we're on mute. We're getting some background noise. Okay, when is cash allowed? Well, it's right there. First of all, it's got to be deposited in the bank. We have to get a letter from the borrower explaining how and why it all happened. And it has to fit their financial profile. Does it make sense? If you've got somebody who gets their paycheck direct deposited to Wells Fargo and they pay 30 bills a month out of that Wells Fargo account, that's not the borrower profile that saves cash at home. But maybe it is. What if they're taking out 1,000 a month and putting it away? And they give us 3-4 months of bank statements and we see $1,000 a month in cash coming out every month. And the borrower says, hey, I've been doing this for a year and a half and I've saved up $12,000 at home. It's sitting in the piggy bank and I'm going to go deposit it. And that's where it came from. And they showed us that we could do it. It's allowable. Chris has got a transaction going right now where the person gets a $3,000, $3,100 retirement deposit every month, and he goes in and takes $2,500 out like the next day, every month. Chris went back and got a year's worth of bank statements showing that within a day or two after that deposit, the guy took out either $2,400 or $2,500 every single month. And now he wants to come in and put $30,000 down. And the average underwriter is going to absolutely puke on that loan. And we're going to justify it. We're going to show it. Now, Again, it's not all puppy dogs and rainbows. FHA's got some other drawbacks besides the mortgage insurance. All government loans, FHA and VA, if you are in a community property state, we must count non-purchasing spouse debt into the qualifications. That means Texas, it means Florida, it means, I think there's a 9, I Googled it once about a year ago. I think there's 8 or 9 states that are still community property states. If you're in a community property state, they have to qualify with the debt, but they still don't have to go on the loan. And FHA very specifically says you cannot use the non-purchasing spouse's debt or credit score as a reason to decline the loan. All you do is include their debt. FHA only does owner-occupied loans. They don't do second homes. They don't do non-owners, no investments. The only exception is you can do a streamline. So if somebody, bought an FHA, they lived there a couple of years, they moved out, bought another house, held it as a rental, even though we know it's a rental, they can still do a streamline refi on that because it was owner-occupied at one time. Here's one. This is a good one. I mean, it's bad, but I'll tell you why it's good in a minute. FHA says if you have extenuating circumstances, you can do less than 24 months on the BK. You can do less than 36 months on the foreclosure or short sale. FHA actually defines what that is. If it's a medical catastrophe or death of a wage earner, can reduce the waiting time. Divorce and job transfers are not extenuating circumstances. And we see that used as the excuse all the time. Well, I got divorced. And the divorce wiped me out. How many times have you been told, the divorce wiped me out? I've heard it a lot. FHA doesn't care. It's not a good enough reason. Now, the reason why I say this is interesting is that Fannie and Freddie do not say that. They don't say that. They do not exclude divorce and job transfers. What they say is extenuating circumstances, and they leave it open to the underwriter for interpretation. FHA is much more definitive. Death of a wage earner, medical catastrophe. If you're self-employed and the business has a 20% decline year over year, the mortgagee must downgrade that and manually underwrite. Now, this is a disaster. This would be a catastrophe. There are several circumstances we're going to talk about in a minute where you have to manually underwrite a loan. And as we talked about in the beginning, right now, Jet Direct is not doing manual underwrites of FHA loans. Does that mean we have to decline the loan? Yes. That's what it means. Will some other lender do it? Yes. Very few, but there are some out there that will do a loan that we can't do. And you all know how I feel about that. I feel that I want to work somewhere where I close loans that other people won't close. This isn't that. This isn't an underwriter's discretion or judgment call that's causing us to send these loans away. This is lack of saleability in the secondary market. It isn't that we won't do manual underwrites. It isn't that we don't have underwriters that can't do manual underwrites and haven't done them for years. It's that they won't buy the loans. So that's where we're being held up right now. So if you see this, it's a real problem right now. But let's assume that that goes away next month and we're able to start manually underwriting again. Here's the takeaway. There are several other things that you must do on a manual underwrite that you don't have to do on an automated. Several more. Okay? You have to get a verification of rent. You have to get more documentation. Collection accounts and charge-offs become subject to an underwriter's, they become subjective, and an underwriter could choose to decline a loan based upon a credit profile, When the AUS, if it says I'm good with the credit profile, then we're good with the credit profile. If you're manually underwriting, an underwriter doesn't have that to fall back on. So if you see too many collections, too many judgments, even with payment plans, et cetera, you could decline the loan for credit, even if you had a 650 credit score. Now, you don't see it very often, but you could see it. So if you go manual underwrite, you have additional documentation issues, you have subjectivity in the underwriting process issues, and you also have much more conservative ratios. We'll talk about that in a minute. So if you go manual for any reason, all manual conditions or procedures apply. This is a bad one. I hate this about FHA. They did this change over 10 years ago, and I hate this. If you're off the job for any reason, and the reason I hate it is that there's good reason. This isn't just because of somebody who job hops. This includes maternity leave. If you take your 120-day, your 90-day, 120-day maternity leave, this does not apply. You take longer than that and you're off the job and you come back, and it can be not just for maternity leave, it can be for any reason. You must be back on the job for 6 months before they'll use that income to qualify. And if that's the case, we must go back prior to the time you were off and document a full 2-year history. Fannie and Freddie don't require this. You could be off work for 5 years, be back on the job for 6, 8 months, 4 months. If DU accepts it, it's acceptable. It's not with FHA. You must be back on the job for 6 full months to use that income. And we then need to go back. So, well, what about the case where, somebody worked for, a while and they took off 5 years to stay at home with kids. They've been off work for 5 years. They go back on the job. They're on the job for 3, 4 months and they're salaried. Doesn't matter. They got to be back on the job for 6 months, and we got to go back to 2015 and find that previous job. Now, there's one obvious exception to that comes to mind. If you're off for years and years, but you take part of that time and you go to school, now you come out with your degree, then those rules would apply. If I come out, if I can show that I've been at school, remember, school counts for work history purposes. School counts. Otherwise, 6 months on the job. Something that Fannie and Freddie do and VA do not require is we must verify the donor's ability to give. So FHA has been burned before. We say the gift comes from mom and dad, and a week before that, somebody went and gave the money to mom and dad to gift to the borrower. Well, if it's documented right, we never see that on a Fannie, Freddie, or VA loan. On an FHA loan, we must prove the donor's ability to give. That traditionally doesn't have to be, but it traditionally includes the previous month's bank statement. So if you're going to close a loan, 5th to the 10th of the month through the 15th of the month, we need last month's bank statement. And then once the money comes out, we need to get a month-to-date printout since that last statement. And if there's any large deposits on mom and dad's account, we have to show those. The whole idea here is FHA has been burned for tens of millions of dollars in defaulted loans on gift monies that were not gift monies. It was the builder giving the money. It was the seller trying to circumvent to make a sale. The real estate agent had put together a creative shared equity deal with an investor. They were the investor. Lots of those things go on. FHA does not have any documentation waivers for income. A lot of us who are used to doing Fannie Freddie loans, DU says, give me one pay stub. DU says, give me one pay stub, one W-2. There's no doc waivers on an FHA. So for those of you that have gone through my documentation training and I say 2, 2, and 2, the 222 rule, the 222 rule applies to all FHA and VA loans. You will not get documentation waivers through your AUS. And then I had mentioned this earlier. When you do a manual underwrite, you are limited to 3143 on your ratios. That is a hard cap. Unless you have certain compensating factors. And there's a whole chart. Again, they don't leave it to the underwriter's discretion. There's a whole chart. It gives like 5 different layers of, well, if you've got this comp factor, you can go up 2 more points. And if you've got these 2 comp factors, you can go up these 4 points. But 40, 50 is the absolute max under any circumstance. And a lot of you hear me talk all the time that we can do 55, 56, 57% DTI on an FHA loan. You hear me say that all the time. And we can with an AUS, not manual. With a manual, you are capped at 50 no matter what. It is a hard cap. So this is a list of a lot of the things that make FHA unattractive, or at least the details make it harder. Oh, forgot the last one. Now, here's one that really hurts. You run your AUS, you have an approval. This one hurts. This one has cost deals before. Chris, I keep using you as examples. Chris had a deal that this just about bit in the butt that he closed a couple of months ago. He ran credit. I think they were about a 620 something, 630, which was fine. They're going to pay a little higher rate, but that's a normal FHA loan. But they had 2 or 3 disputes on that credit report. They had to go to the bureaus, remove the disputes, and rerun credit. And the credit came back, if I recall correctly, at a 603. Does that sound right, Chris?
What, from a 623 to a 602? About 10 days before closing, maybe less than 10 days before closing.
They came within 2 points of losing the deal. Because again, we don't have any investors that'll go below 600. Whether you get an AUS or not, they just wouldn't do it. And this, we had an AUS on it. But with Fannie and Freddie, they allow DU to read and interpret the severity and the impact of having a dispute. FHA does not allow that. FHA says, we all know if it's a disputed account, it gets removed from the credit score calculation, which is why people will run out and dispute, and their 580 trashy credit becomes a 620, and now they run and get the loan, and then their scores go back down. Again, FHA learns from their previous mistakes. And you can't argue with them, because if it was a Fannie Freddie, that loan was dead on arrival. It would have never even have been originated. So, you know, it is what it is. You need to on an FHA loan. The minute you run credit, I know you're just used to looking at credit score and saying, oh, we're good to go, because you're used to doing conventionals. Do not do that. You need to read all of your FHAs. And if you've got disputes, your credit report is artificially high. We have to remove the disputes and rerun credit to get a new score. Well, what happens if they went out and charged out their credit card during that time? Yeah, we're screwed. What happens if they went and bought a car? Same answer. Well, what happens if something else happened and their score goes down? Yeah, I know. So even with an AUS accept, we must downgrade to a manual underwrite if the disputed counts are greater than 1,000, if your significant credit events is shorter than the time required, or if that business income declines greater than 20%. They actually have some other reasons to do manuals, but you'll never see them. So what we meant on that significant credit is, remember we said, hey, it's 24 months on a BK, but they will do less than 24 months with extenuating circumstances. I've had 18-month bankruptcies get approved through AUS, but an underwriter still has to look at that. And when they do, all the other things apply for manual underwriting. But Lyman, you said we're not doing manual underwrites right now. That's right. So you're not going to get any extenuating circumstances approved in today's COVID world. You're going to have to wait the full 24 months on a BK. You're going to have to wait the full 36 months on a deed in lieu short sale or foreclosure. Does that all make sense? We're getting kind of pretty detailed here. But I'm going to email this PowerPoint to each of you at the conclusion of this class. So you'll have this. Questions about that? The reason that a lot of real estate agents do not like FHA loans is because they require the property to be in good condition. And real estate agents they've all gotten fat, dumb, and happy with this market the last year or two. We got cash investors running in. We don't care about appraisals. We don't care about pest reports. We don't care about the condition of the property or broken windows. I got me a cash investor. Okay, great. Well, guess what? FHA doesn't care about any of that crap. So if you've got a realtor that you work with or a listing agent that you're putting in an offer and they will not accept an FHA offer, and there's a lot of those agents out there, they put it right in the MLS, conventional offers only, cash offers only. Great, I get it. I can't fix that. I can tell you why, and most of the time it's because of the property requirements. And the reason that FHA is such a stickler is because FHA borrowers don't have any money. These loans typically close with no reserves. There's $200, $300, $400 left over in the bank. That's it. That's a very normal FHA loan. FHA buyers are usually first-time home buyers. They're not experienced in serious home repair. They don't know how to work with home maintenance issues, and they don't have any money in the bank. So FHA requires the property to be in better condition. It cannot have any health and safety issues. If an appraiser identifies a health and safety issue, it's got to be repaired prior to the close of escrow. What are we talking about here? No steps off the porch, no guardrails on any staircase anywhere, interior or exterior. Health and safety, health and safety. Lead-based paint from 1978. Any exterior that was built prior to 1978 that has peeling paint, they got to scrape off the paint and repaint it. What else? Pools, but I talk about pools here in a minute. Clear Section 1 pest reports. Now, this does not apply to the whole country. It does apply to California. Wherever you're doing business in whatever state you're in, you're just going to have to find out if you have to have clear pest reports or not. Section 1 pest reports must be cleared in all FHA and VA loans in the state of California. Why? Because we have bugs. Diane's in Wisconsin. Wisconsin probably doesn't have any bugs. They probably don't require a clear pest. I don't know. Diane, do you know the answer to that question? I can't tell if Diane's still with us. Sorry. Okay. So you got to check your state. What is clear pest? Clear section. What is Section 1? Section 1 is active infestation or damage caused by active infestation or dry rot. So your posts on the patio deck are rotten. It's got to be repaired. The rails, the decking itself, it's got to be replaced or tear out the deck. Existing pools must be operational or filled in. My tool, so that's okay. I'm going to go run out and spend $2,000 and put in all new pool tools. It's okay. No, it's not okay. The appraiser's going to go out. He's going to turn on the tools. And if they don't fire up, now the heater doesn't have to work, but the pool must be functional, because if it's not functional, it's dangerous. Does that mean it has to be surrounded by a fence? Yes, you must meet local pool standards for health and safety reasons. The appraiser will examine the attic and the crawl space for any water damage or leaks. Most of them don't actually do that. Most of them will open up the attic access, they will hold up their camera, they'll take one picture. They will open up the crawl space, they'll look in and they'll take one picture. They don't crawl in there, they don't crawl around, they're really not looking for issues. But if in that one picture they see an issue, and it happens, but I haven't had a crawl space or attic issue heard a deal in 15 years. Because they really don't go look. They shoot a picture, they put it in the report to show that they inspected. That's their definition of inspection. Head and shoulders. In a seller's market, it can be difficult to get a seller to pay for the needed repairs or pest work. I get it. And if your FHA buyer is competing with a cash investor, you may see a situation where they'll take $5,000 less money because it's a cash offer and they don't have to deal with this crap. I get it. It is what it is. Can't fix that. But the FHA 203K can fix it. Hopefully y'all took the class last week and this week. Buyers are allowed to pay for those repairs. They just have to be done by the close of escrow. Part of the realtor's commission could go toward it. What if the lender cannot pay for the repairs out of their rebate pricing? But what if the buyer takes $3,000 of the money they had to pay closing costs to pay a repair bill, and now the lender rebate of $3,000 goes toward closing costs? That's allowable, my friends. You just got to be smart enough to put that puzzle together. Yeah. Questions? Covered a lot of ground today. If you don't have questions, you haven't been listening. Really? You just all enjoy looking at my face right there? Okay. Well, watch this face. This is a frowny face because you're not asking me questions. You've got to have them. Oh, okay, I got to chat. You didn't really go deeper into ratios. Okay, good one. With an automated approval, we will see payment ratios up to 45. We will see debt ratios up to 57. Over 45 and over 57, you won't see an AUS. Well, do I have to have a 780 credit score and $16,000 in the bank to go that high? No. FHA considers 1 month payment a comp factor. I have gotten 56.5% DTIs through all the time, where we had no reserves and it was a refer. We put $2,000 in a savings account, reran it, now it's approved. 1 month's reserves can change 25, 30% of all of the refers I have ever seen in my entire career will change it to an approval. Just 1 month's reserves. Crazy. You don't see that in conventions. Good credit and reserves are the secret to an FHA and high ratios. And oh, by the way, good credit to FHA is 680. 680 to FHA is like 740 to conventional. I've got 660, 670 loans with 55% DTIs through all the time. Maybe you had 1 month's reserves, maybe not. Now, are you going to get a 625? No, you're not. A credit score below 640, you better not be pushing ratios past 48, 49. Other questions? You're hurting my feelings. I've poured my soul into this presentation. You know how long it took me to make that PowerPoint? I'm not that good a trainer, you guys. You've got to have questions. Come on. Really?